Hi, folks. We're getting ready to roll here in just a minute. If you can be patient, we've got a few more people coming online. Now I have to wait for Nick to get back anyway. Shall we get rolling, Nick?
Yeah, let's kick it off. I know we've got a couple people registered that aren't on yet, but in the interest of time, I think it makes sense, and we can always send the recording out to people too. So,
all right. Well, welcome everybody to what I think is the 6th installment of our quarterly client webinar series. And today we have a pretty cool topic. We're going to cover environmental, social, and governance-oriented investing with Dr. Apollo Lupescu from Dimensional Funds. So Nick and I are excited to welcome Apollo. He's a vice president at Dimensional Fund Advisors, which is one of the premier investment advisory companies in the world. They manage over 600 billion in assets. Paul is nationally and internationally recognized as a speaker who delivers hundreds of lectures and seminars to financial professionals and individual investors on all sorts of investment topics. I think I've heard Apollo speak 3 or 4 times now personally, and I've always enjoyed it. DFA considers him the secretary of explaining stuff. I don't know if that's official business card or not, but that's pretty cool. I like to be the guy that gets stuff done, so we put that on mine. But he's really good at answering questions in a clear and understandable way, and I can attest to that. Apollo's been with Dimensional Funds in Santa Monica for over 17 years. Prior to that, he taught at the University of California. He got a PhD in economics and finance from the UC Santa Barbara, and he holds a BA in economics from our own Michigan State University right here in East Lansing, where he competed and coached for the water polo team. So the rumor is he's still an avid player. During the pandemic, you took up surfing. So
I did.
have to tell us about that, Apollo. This is interesting. No.
Well, hey guys, hey Nick, hi David. Well, thank you so much, first of all, for the invitation. And it is probably the most important part of my bio, my alma mater, Michigan State. And in fact, I was just looking just a few days ago, and I found this hat that I don't know if you guys can read, but it is my Michigan State water polo hat. And for the folks who don't know, Michigan State does have a water polo team. It is not exactly, I mean, it's a great club, and we did win the Big Ten championships when I was there. This is years ago, but I know it's not a household sport, but I know it's getting bigger in Michigan. Anyway, just a little plug for the sport. It's a great sport, but I had an amazing time, and I still have a lot of friends from that team that I stay in touch with even up to today. So great experience. But surfing, I happen to live in Los Angeles. There's this big body of water, and in the pandemic times when he couldn't do much, that seemed to be a pretty safe thing to do. And and I thought, why not? Like, I'm 50 plus, why not try something else? Might as well. As long as I don't get hurt, I'm a happy guy.
Good. So today we're going to talk about ESG investing, which has been a very very interesting topic lately for a lot of reasons. And so maybe kick us off by giving us an overview of what ESG investing is.
Yeah, and ESG has been an incredibly hot topic lately among investors because there are a lot of advertisements. There's so much that investors are being just bombarded with when it comes to this idea of ESG investing. So let's just kind of take a step back and understand what exactly is ESG investing. So ESG investing basically stands for 3 different words, 3 different ideas. They're packaged in this concept of ESG investing. The E stands for environmental. So these are situations where people want to invest in a way that not only would help their portfolios, but also perhaps would have a sustainability aspect to it, and it would be very environmentally friendly. So the E stands for environmental. S stands for social, and this is socially responsible investing. And if you think about socially responsible investing, that becomes a little bit harder to ascertain exactly what is socially responsible investing, because when you talk about environmental, I think a lot of folks who say sustainability is a really kind of common cause there. But when you come from a social perspective, well, there are different causes. You have religious folks who are more on the religious side. You have social if you are on the left, and social if you're on the right, and these don't always align. So describing the social aspect becomes very complicated. And then, you look at even like companies that are in the news today, like Facebook, and some of them are they socially responsible companies? And it becomes much more subjective. So we have E for environmental, S for social, and G stands for governance. How are these firms being run? Are they doing the right thing? And in that respect, sometimes you look at it, are they doing the right thing for investors? Because ultimately these CEOs and boards are shepherds of our money, because we invest, we're owners in this company, and we trust that the board of directors and the CEOs are looking after our interests. Or sometimes governance is even addressed, like, are they taking care of their employees? So when we think about ESG, it's a mishmash. It's a combo of many different things are kind of thrown in there and packaged in this acronym of ESG. And I believe in my heart that ESG, in fact, stands for something that is a lot more important and meaningful. ESG is trying to align your investments with your personal values. So if you think about in that respect, I have a certain a set of values, and I really believe in that as an individual, as a family. And in the past, perhaps it wasn't as easy to align these with my investments. Well, right now, what this ESG is trying to do is bridge and help investors align their values with their money. So in that respect, I look at ESG more of values, not values investing. How do you align your values with your investments? And what becomes tricky, guys, is that you have these three different components that are packaged all into one, and that becomes something that is very hard to accomplish in a productive way. If you just toss everything in there and just say, I want all of these together. So we can talk more about how do you separate them, but to begin with, that's what ESG is, and that's why a lot more folks are drawn into this, because I think that as society, we have become more attuned with our values. We try to implement our values in other parts of our life rather than just the personal preference just around our immediate consumer behavior.
So, Apollo, obviously you've dealt with lots of investors in your role. Your role. What do you think, based on your experience, what you're seeing out there? Why are investors interested in ESG investing?
Right. So I think that I would say there are two or three different categories of investments, and I think the reason they are interested in ESG investing is because they feel they want to have a positive change into the world. So I think it's an incredibly noble aspect, and the first category of investors are the folks who are really looking at sustainability. And they're looking at sustainability maybe with two different lenses. The first lens is that I want to hold companies that I believe are good for the environment. They're not damaging the environment. They're sustainable, and I want those to be emphasized in my portfolio, and not so much the ones that I don't think they're as green. I think the ones that pollute or whatever, those are the companies that I perhaps don't want to have in my portfolio. So you have these folks that have that preference towards the companies that they hold. You have a second category within this sustainability environmental category of investors who are perhaps asking, well, by investing in these green companies, would I actually make more money? Would I be able to earn extra returns because these are companies of the future? These are technologies, and the world is moving towards a green future. So by investing in this, could actually generate higher returns for my portfolio. So the reason that the environmental category exists is because of these two categories, either because to satisfy a preference or because they think the returns could be higher. So that's one group. So that's what I think interests people about environmental. The social aspect of it, I think, is a lot more about preference. It's a lot more about feeling that I'm doing the right thing, and I just want to have these companies. I don't hear as many folks saying that I want to invest in social responsible companies because they will hurt or help my portfolio. They just feel like that's part of who they are, and they don't want to do it. So that's a second category. And again, in this, you have, political reasons, you have religious reasons. So there, by the way, even religious there's not one religion. So you have multiple groups that have multiple, perhaps, criteria for the social responsible investing. So you have the environmental, you have the social, and then the third category of investors, it really are concerned with the governance. And here's why, Nick and David, is because we are owners into those businesses. So when I buy a share of Apple, when I buy a share of Google or Exxon, you name it, every company out there, we become part owners in that company. And buying that company basically is good because now we own a piece of it. But the thing is, we are, as part owners, we ought to be involved, and we ought to make sure that the companies are governed properly. So there is a group of investors that are looking at this and saying, we want to not necessarily be activists. We don't want to be there and then just kind of beat up on this, but we want to understand, and we want to partake in the ownership of these companies as responsible shareholders and be able to vote on whatever motions are put in front of the shareholders, and make sure that we understand what they are. We look at the board of directors and who's going to be overseeing the CEO and the leadership, and we want to make sure that we know who those folks are and vote for the most appropriate folks. So that's the governance piece. So I think that if you look among these three categories of investors, you can see the appeal of ESG, because all of these are things that are important to investors. But I think the message that I want to send clearly from the beginning is that ESG is not a monolith. It's not a unified strategy. It doesn't mean just one thing. It means three different things. And even within those, you have subcategories of investors that might be interested in one or another. But to begin with, as you think about ESG, think a bit more specifically. What is important to you? What is it that you really want to get by investing your money this way?
So, Paulo, I think the first time I had a conversation with someone about socially conscious investing, and back then it was just social. I don't think there was the E and the G in the equation yet. It was long ago. But, I remember looking at what was available and having that conversation with some interested clients, and that, there was a real trade-off between, putting your money where your values were and what you could expect in return based on expenses and just really kind of clunky options. So could you maybe talk a little bit about what has changed as interest in this has peaked? We're starting to see some new tools out there.
Yeah, and you're absolutely right. This is not something that emerged in the last year or two. This has been around for a while. But the reason that really didn't caught on are because of I think of three things that really kind of hampered the growth of this particular area, whether it was E or the S or the G. And the first one was the fact that a lot of folks, when they created these funds, and there are some funds that are built around environmental or socially for a long time, when they were building them, they were not really thinking about the investment piece per se, but they were thinking much more in terms of, the companies that I want to own, and the investments came second. And because of that, these tended to be very concentrated investments. They're just a handful what were considered to be the really good companies, a lot of exclusions. So a lot of these investments back in the early days were very, very concentrated into a handful of companies. The second problem was that the performance of these funds was not very good. Because they're concentrated and because investing per se was a secondary thought after I just want to make sure these companies are good from that particular criteria, whether it's environmental or social. Investment came second and the performance was really not good. So a lot of folks were basically saying, it's not something that I want to trade off. I don't like the idea. Yeah, I might be doing the right thing, but I don't want to leave so much money on the table. And then the third element was around cost, that the fees associated with managing these funds, which you all have to pay, that there's a management fee associated with funds typically, was much, much higher for these environmental funds or sustainability or social funds than it was for the regular funds that didn't have these screens. But today, I think that what's changed is, and there's a fourth element, by the way, which is it was in the eye of the beholder. It wasn't as clean to come up with a criteria of what you might want to put into those funds. And I think that today, what's changed is all these four things that I mentioned there, they've kind of moved on. Right now, if you look at funds that are, let's say, environmental or socially responsible, what you're seeing is that they do have, if they're good funds, they do have a starting point where they are paying attention to diversification. So they're not hyperly concentrated into a handful of stocks. So they are, diversified and sometimes not vastly different than you would have in non-regular funds. When it comes to performance, they tend to be a lot more aligned with the performance of non-sustainability, non-socially responsible funds. Costs are pretty much coming to be very, very similar. So what it all drives to is that today you could have a fund A, which has these screens around sustainability or socially responsible funds. And when you look at this fund and you look at a fund B, that is just doesn't have any of these. It's just a regular investment fund. Well, what you see is that from a diversification perspective, from a performance perspective, or from a cost perspective, they tend to be very, very similar. So at that point, well, that's pretty powerful. If I can substitute and instead of buying fund B, I can buy fund A, which has very similar investment objectives, very similar diversification, very similar costs. And at the same time, I can introduce my values. I can actually align my values with that investment. Well, that's a very powerful proposition. So I think that's what's changed is the diversification, cost, and investment objectives and performance. I think they are much more closely aligned today with funds that have or don't have these sustainability or socially responsible filters.
So Apollo, when we talk to our clients about ESG investing, it kind of seems like they fall into two different camps in terms of some of them think that ESG is going to give them better returns, and some of them are worried that it might hamper performance. So I'm curious what your take is on how ESG investing would impact expected returns.
Yeah, that's a very good question. So we looked at that particular issue. Does ESG investing help or hamper returns? And what we found is that when you look at the performance of an investment fund, there are some dimensions of that portfolio of the investments that are put in there that make a huge difference. And those are, first of all, are these companies large or small? Are these companies, what is the price that you're paying to own that company? So if you're looking at how much does it cost me to buy $1 billion in assets, which is something called price to book, for example, that gives you that metric of how expensive is the company. So, and then you also look at the profitability. Is this high profitability, low profitability companies? And what we found is that when it comes to performance into an investment fund, these three characteristics of the portfolio are the most significant drivers of expected returns for an investor. And when we looked at sustainability or socially responsible investing, we did not find that they're the primary drivers of performance. So in that respect, if you have a fund that really focuses on these three characteristics and then applies an overlay of sustainability or socially responsible investing, the drivers of performance are left intact. If you can leave those intact, then you have very similar results. So we didn't find that putting these screens would necessarily change the performance expectation of the portfolio. On the other hand, you have some folks saying, well, listen, when it comes to, let's say, solar panel or green companies, well, certainly these companies are going to have a lot more business and they're going to, make a lot of money in the future. So maybe we want to invest in those. So is there something about the green companies themselves just making more money? And what we found is that is not necessarily the case, because what we found is in the stock market, both in the US and abroad, investors are really smart by now at looking forward, looking ahead. And if they're saying that this particular solar company or whatever, you name it, if this particular company does have really good prospects because of the way the world is going in their direction, the price that you're paying adjusts very, very quickly. So by the time you buy it, the price could be pretty high. So in that respect, it doesn't necessarily lead to a high return if the price is already bid up. In other words, trends that are very visible to all investors, they're priced in very, very quickly. So when you get into those, it doesn't necessarily lead to high returns. It's the trends that are not really visible, they're not obvious, that might lead to that. But right now, the environmental screens, this solar panels, all the green, it's on everybody's radar. So the price is already bid up. So it doesn't necessarily mean that you're going to make a huge killing on that. So from our perspective, environmental is more of a preference. You put it in there, and it doesn't necessarily mean that it will help or hurt in the long run, because the expectation of these returns comes from, do we own smaller or larger companies? Do we own high or low price companies? And do we own profitable or unprofitable companies? And these criteria go across the sustainability as well as non-sustainability portfolios. And just to make that point, and this is, I'm always, just want to be careful whenever I use performance. But the reason I want to show some performance is because we have two different funds that have a very similar investment objective when it comes to the size of the companies. It's a broad market portfolio, but it emphasizes a little bit more the smaller companies relative to large. Again, this is across the 3,000 stocks or so in the U.S. market. They looked at the low price value stocks versus growth, and they look at profitability. So these are very similar in terms of their investment objective. Now, one of them, it was set up back in 2008. It has sustainability filters on it. So it has that preference where some of the companies are excluded, some of them are underweighted, but it's similar diversification, similar costs. And the question is, would you have done better with the sustainability or without the sustainability? So when we actually look at the numbers, this is as of mid-year, as of June, what you see is that if you look at the regular fund, which is called US Core 1, Core Equity 1, and you look at the growth of the portfolio since April of 2008, this is when the sustainability fund was started. What you see is that relative to that sustainability fund, which is in green, it's very, 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 very similar. The sustainability has a little bit of an edge. As you see here, the growth of $1 is a little bit higher, slightly higher in the sustainability fund. And the reason for that, you can probably guess, is that somewhere around here when the pandemic hit, some of these energy stocks just really got hammered, and they didn't do very well. And at that point, the sustainability fund in green ended up kind of getting an edge. Now, as of this year, for example, these energy stocks have been doing tremendously well. So, for a fund that has them, that they would have helped that fund. For the fund that don't have them, for this particular period, it's not going to help as much. So, when you think about these two different investments, the one thing to look at is that they're, the expectation is very similar because of the characteristics in size, relative price, and profitability. But from period to period, you are going to see differences. And sometimes the sustainability will benefit, and sometimes the regular fund would benefit. But by and large, you don't see a big difference in expected returns between these. So it's much more, think of it as a preference. It's a preference that I have. And this is really designed to satisfy that preference rather than add or detract returns for my investments.
Love the charts. If you had told me that as a, if you had told me that 10 years ago when I was having those first conversations around this topic with people, I never would have believed that in 2021, a fund using those screens would be neck and neck with one that was otherwise very similarly constructed. So that's pretty cool.
Yeah. Well, and again, I mean, it comes back to this. This is a really important conversation with investors. It is much more about the characteristics of the fund. So just to kind of highlight this, you looked at the sustainability core, the one that you saw there. And let's just take the main things that really are important to investors. First of all, how diversified is it? Well, in the entire stock market, broadly speaking, there are about 3,079 companies that investors can buy and sell. The sustainability core held about 2,100, and the regular fund, which did not have the sustainability filters but similar objectives as an investor, 2,500. So you're still very diversified. You're not going from 3,000 to 20 holdings. It's still very diversified. When it comes to the size of the company, what's the kind of the weighted average among all these companies? What you see is that for the sustainability, it is about 310. This is in billions, so this would be in billions. So it's about 310 billion, which is not vastly different than the regular fund, but it is less than the market as a whole. So that's what I was telling you, that you emphasize a little bit more the smaller companies, so this number comes down. When you look at the price to book, we mentioned that price to book, which relates to how expensive it is to buy, let's say, $1 billion of assets. Well, in the stock market, it would cost you about 3.95 billion to buy a single billion of assets in terms of the book value, and the equity one and the sustainability, again, very, very similar. So in that respect, again, I want to come back to this idea that it is very similar in performance, but the reason for that, the underlying reason, is the characteristics and what actually is being held in the portfolio satisfy that preference, but it's not again, different from these dimensions than a non-sustainability fund.
Yeah. So where do you see ESG investments going from here, going forward?
Well, I think that I can speak for Dimensional a little bit. I think that there are 2 or 3 things that are really important. The first one is that investors are well served separating between E, S, and G based on their own values and based on what they're looking for. And that's what we've done, is basically we created a set of funds that are specific to environmental, both in the US as well as international markets and emerging markets. So those are specific funds that are for environmental. Because if you're trying to blend in and put a bunch of stuff in there, environmental, social causes, it just becomes really a mess. So separating this and saying, we're going to have investors who are interested. There's a set of funds specifically on that. There's a second set of funds specifically around socially responsible investing. And I think that's another big area. We've had those funds for over 12 years now. I think it's closer to 15 years that we've had the socially responsible. And those are a different set of screens than they are for the environmental ones. The second thing that I think it's important to look at is that right now there's no real consistency in terms of how investors view different companies and whether or not they are environmentally sound or not. Even if you think of solar panels, you just research a little bit and you find out that, boy, solar panels might be green because they provide clean energy, but on the other hand, they're really dirty when it comes to the production itself of the solar panel. A lot of folks are going after the energy industry, but on the other hand, you also have a lot of methane being produced from agriculture and other industry like steel and so forth. So it's becoming a little bit more of particularly sustainability, a little bit more of a play in understanding how do we measure that, how do we evaluate companies. And right now, if you look at different companies and you say, well, is this company green or not? How is that company when it comes to the environment or the social or the governance, these three things? The companies are getting into this business of providing scores and letting investors evaluate. And this is an article that was published in the Wall Street Journal. I'm going to show you the live website where the question was, what's a sustainable company and what's not? And in this particular case, you had this company called Sustainalytics, and it was looking at Tesla, which we all know Tesla. And what they found is that, when you look at Sustainalytics, which is the circle, and you look at Financial Times, which is also called FTSE, which is a different provider, and then MSCI, Morgan Stanley International, Capital International, which is a third provider. So these are three different providers evaluating exactly the same thing. What you find is that when it comes to FTSE and the environmental aspect of Tesla is at the very bottom. It's at the very bottom, where MSCI ranks it at the very top. So it's who do you believe? Who do you believe if you're an investor? Because it's all over the place. When it comes to social, again, Tesla stores the bottom, and Sustainalytics puts it somewhere in the middle. When it comes to an overall score, again, look at the difference between these providers. And it's not just Tesla. In that article, you also see all of these other companies and you see how diverse they are. But if you look as an overall score, it seems that when you look at, for example, Morgan Stanley, they tend to think that overall Tesla is in the below the 25th percentile, whereas Exxon is probably more as a whole, ESG more so than Tesla. So it's really interesting to look and say, how do we now go and try to be a little bit more rigorous, a little bit more scientific in understanding what these companies truly are. And one of the things that we've tried to do at Dimensional is really emphasize the data. How do we collect the data? How do we take information about these companies, be very specific on what we're trying to objective and be able to measure that and ultimately create a score. And I think that's, in my opinion, two of the things that we've done that's really phenomenal is one is really give each company a particular ranking based on rigorous data. And we've created a proprietary scoring system that's different than these folks to try to evaluate what is the score and what is the environmental score for each one of these companies. So that's the first thing that the data can help us do. The second thing that it can help you do is really understand what is it that you can accomplish by doing that. So not just saying it and say, oh, this is good for the environment, but actually what's the outcome? What's the impact that you're having? What's the, for the goal that you set yourself, how did you do? And in our case, greenhouse gases and emissions are a really big part of what we're trying to accomplish with the sustainability funds. And one of the metrics, for example, that you can look at is what's the reduction in emissions exposure, particularly greenhouse gases, because they're tied to climate change. And when you look at the market as a whole, these are the 3,000 companies in the Russell Index, and we talked about it a minute ago. That's the most comprehensive way to look at the stock market, more so than the Dow Jones or the S&P. And when you look at these 3,000 companies, there's a certain value associated with the how many tons of CO2 emissions per sales, which is a metric of what's the greenhouse gas emission intensity. And you compare that with the fund, and you say, what's the reduction in exposure that you can give an investor who might choose to invest this way? Well, you can see that it's a very meaningful reduction in exposure, 79% relative to just buying a portfolio that does include all the polluters. And beyond that, you can even look at not just what is being produced, but also the potential emissions from reserves. Obviously, if you look at coal, if you look at oil, and these are the megatons of CO2. If you just look at the market as a whole, and in this fund, well, what can you achieve? Well, in this case, you can pretty much do 100% reduction in exposure, and really quantify what is it that you accomplish by investing this way. So to me, you ask what's next. Well, again, it's separating the E, the S, and the G. Second is using data to come up with scores and be much more rigorous in terms of analyzing a company and say, is this sustainable or not? And then thirdly, look and quantify what are the outcomes, what are the results if you were to implement those screens, and how does it change relative to just buying a broad market portfolio. And the last thing that I'll tell you, Nick and David, is that what we also found is that the mutual funds are trying and to walk a fine line where you're trying to satisfy the most common preferences, and that's what we're trying to do. But we also found that some investors have more niche desires, they're more niche preferences. And for those folks, sometimes they say, well, yeah, I get it, but I really don't want any of this company, or I really don't want any of that, or I want more of the other one. And in that case, the only way that you can do this is by having something called separately managed accounts, where you can still, have a very well designed investment strategy, but on top of that, you can customize your screens and your preferences much more to the tailor needs that you have, or to the preferences that are important to you. So I think the evolution of this is for some folks who really are very honed in on certain elements of sustainability or socially responsible investing. What they could do is use a separately managed account, and we have that as an option as well, to really custom tailor what goes into their accounts at the stock level, as opposed to mutual funds, which basically it's good, but it's more of a one size fits all because it's a commingled vehicle. So those are the things that I see as kind of the next frontier for the environmental sustainable type of funds, and socially responsible for that matter.
So forgot to say this earlier, but for those of you in the audience, if you have questions, go ahead and throw those in the chat here as we're wrapping up with our last few. Nick?
Yeah, I'm just have a couple of follow-up questions. So I'm curious on the scores and on the data you keep. How fast does that change? I just have this vision of Mark Zuckerberg from Facebook testifying in front of Congress, and all the ESG people hitting the sell button. Is that like a real-time thing, or like? And I guess the follow-up, more important to that, is when you're dealing with the social aspect, how do you take the emotion out of that, because it's so emotional, because it's such a preference?
Right. So it's a very good question. So let's kind of go back to the three things. So the first one is environmental. If there is a situation where it's completely unknown, and you find out something about a company that is really meaningful in a bad way about environmental, then obviously the score would adjust. But I don't see that personally happening that much. I don't see a situation where a company that we thought it was so green all of a sudden like did something really horribly from an environmental perspective. I don't really see that happening. It's much more on the maybe on the social side, and you brought up Facebook, and I think what's interesting about Facebook is you look at folks and there's not really a well-defined sort of consensus around the country that from a social perspective, Facebook is evil or not, because it's been lately on the news quite a bit, because of some of the documents that are being put out there. The thing is that if you look at the social responsible investing, a lot of times the socially responsible investing had much more to do with child labor and factory farming and landmines and perhaps some around medications or types of medical procedures, or it was a very different set of criteria. So for folks who are looking at ESG and saying, how is ESG treating Facebook? Well, from an E perspective, environmentally, nothing has come up new to kind of say that Facebook, for example, is terrible for the environment relative to what we knew not too long ago. From an S perspective, a social area, again, given the screens that have been typically put in place for social, which is against it's much more about certain criteria: tobacco, alcohol, firearms. So those are typically the criterias that are in the socially responsible investing. Well, that again doesn't quite fit in that either. So that leaves it for the third bucket, which is G. And G has to do with governance. And this is a really important piece, because at Dimensional, one of the things that I've come to appreciate is that when it comes to governance, there's not a set of funds focusing on governance, but every single fund. Governance applies across every single thing that we do at Dimensional, because it ultimately has to do with is how is the company run. So I guess what I'm saying from an ESG perspective, it's not easy to fit Facebook into the E or the S. The question is more on the G. From a governance perspective, the fact that they're doing things that are not really kosher, by trying to hook teens or by promoting or demoting certain groups, whatever the case might be, does it mean that it is impacting the long-term prospects of existing shareholders, that by the virtue of their actions, they are hurting the shareholders in Facebook? And that is indeed something to be considered. So to me, when I look at Facebook, I think it fits more in the G. And I think that's the question that needs to be looked at. Are these actions reducing shareholder value in Facebook because they're not in the social interest, because they are kind of targeting groups that they shouldn't be targeting, or whatever the actions that they're doing? It's not whether they're good or bad for society. Much more is that how are they impacting shareholders? And I think that's a different way to look at it, because I don't know that it's easy to fit. There's some statistics that I read that, as you said, a portion of the teenage population might not be feeling great when they use Instagram, and yet reading the same article that 3 times as many kids their age are feeling better because of Instagram. So it's kind of hard to say, to fit it into any one of these categories. But I do think that the G is the one that it's the most interesting to look at.
Good. So we do have a couple of questions from the audience. I believe this one is referring to that chart you had from the Wall Street Journal there with the FTSE and MSCI scores. And the question is, do they reveal their process on how they got those scores, and are they transparent? And how do they relate to competitors?
Yes, I think. Yeah, all of these are somehow transparent, and I can't imagine they're doing everything in a vacuum. But everybody has different things that are important to them. And what I'm saying is that the scores can vary widely depending on what is more important. What weight do you put on different things that a company does or does not? And that can create vastly different scores. So the weight that you assign to different categories, you might have exactly the same categories, but if you emphasize one more than the other, you're going to get vastly different scores. So it sometimes it's harder for an investor to kind of disentangle and find out. And we do pay attention to that. What I can tell you is more like what we do rather than what these companies do when you look at these scores. And it's, you know, to me, the way that I would look at these scores is first of all, look at just have clarity onto what exactly that you're trying to measure. And in our case, it is climate change. We are looking at climate change. And we do know that greenhouse gases are a big big issue with this. And the first thing that we would do is look at the potential emissions from reserves. So if you look at these, coal mining and on all these fuel reserves that might create emissions, that I can tell you that we put some emphasis on this, and in fact we eliminate these stocks. And then, in our perspective, then if you look at the greenhouse gas emission intensity, one of the things you can look at is something called Scope 1 emissions. And Scope 1 emissions, these are emissions created from the production activities. So whatever you do, and these companies are reporting, and it's not always reporting is not always consistent, it's not always great, but it's getting much better. So you can get these numbers for the emissions that are caused from operations, and that's a Scope 1. That's typically called a Scope 1 emission. But separate from that, there is an indirect emission, or what's called a Scope 2. So one is the emissions that you produce from production. Scope 2 would be, well, if you bought electricity to produce those, well, the electricity that we use actually created some greenhouse gas emissions, and it's accounted as a Scope 2. So we look at both emissions in Scope 1 and Scope 2, and typically that's about 85% of the score. And then beyond that, you have some other considerations that are put in there, and we put a lower 15% weight onto those. So in our case, we try to be transparent. I can't tell you for each one of these companies what exactly they do, what they emphasize, and how much. And it's probably, if you're interested, you might want to just look at them and find out. But I know they're all over the place. I just know what we do, and collecting the data and collecting it from thousands of different companies around the world. It's a huge enterprise, and do it in a very rigorous way to clean the data, to scrub it, to make sure that it's correct, it's accurate. That's a huge enterprise, and that's what we do, every day with these funds.
I'll find that Wall Street Journal article as well.
I can send you a link. Send you a link.
That'd be great. I missed that. Try to read the Wall Street Journal every day. So, and I think the second question, you kind of covered it a little bit, and I think, again, you'd have to speak to Dimensional's approach, but it was how rigorously are those companies investigated, which you just talked about.
Again, you have to look at these, again, I know the question was referring to ESG, but you have to be more specific. Are we looking at E? Are we looking at S? Or are we looking at G? And when it comes to S, I'm not aware of scores. I'm not aware of a score that really, from a social perspective, yes, but so there are some scores, but there's not a universal, there's not anything like closely resembling the sort of at least the semi-consistencies that exist in environmental. So from social, it's even harder to get some of these scores. So you do have, as you saw there in the article, the Wall Street Journal article, you do have these Sustainalytics and FTSE putting not only environmental but social. But in terms of what is social, it's really hard to disentangle, and it means so many different things to so many people. To some, it's even like, what's the diversity on boards? To others, it might be how they're treating the employees. It's really hard because, again, social could also mean, are they producing tobacco products? Are they creating ammunitions. What's their main line of business? Are they selling liquor? Cannabis, whatever the case might be. You have different things that are just much more diverse. And to get a sense of these ESG ratings and how all over the place they are, if you look at Tesla or Exxon or any other companies that are listed out there, there are different agencies, different companies that are evaluating how creditworthy is this company. And the way they reflect that is by assigning their bonds, which is a form of lending money for the companies, assigning them a level of risk. And then the risk is translated typically in like, for example, it's how many letters are associated with the bonds. There's a AAA bond if you're the highest quality, and then it's AA bond if you're a little bit less creditworthy. An A bond is even less, and then you have Bs and so forth. So you have these different categories of risk associated with the bond, and companies evaluating and creating almost like a score that instead of a number, it's created out of letters. And if you look among different credit agencies, when you look at how are they ranking a particular bond issued by a company, they tend to be very, very consistent, very narrow band. They're almost pretty much all very, very similar in what they do. When it comes to sustainability scores or social scores, they're all over the place. In other words, I would say that understanding and to the question that was first asked, which is a very good question, which is how exactly are you computing that numbers? How often are you looking at those numbers? What data goes in there? That's a big question right now. It is a little bit of a black box, and it is a lot in the eye of the beholder.
Mm-hmm. That's probably something we'll see evolve here as maybe part of the next growth in this area.
Yeah, and right now you have some funds that are just simply licensing MSCI or FTSE or Sustainalytics, and they're saying, well, we're going to create an ESG fund. And all they do is just pick up that score, and then they just apply it to the holdings, and maybe they eliminate, I don't know how they exactly do it, but they just simply, they just find that it's easy to sell. So why don't we create a product right now, because it's a hot market for this. And that's not how we look at it. We've done this for 12 years, way before it was popular, and kind of having the data and crunching it yourself, it's very satisfying. It's much better for the end investor.
Very cool. Looks like that's it for questions from the crowd. Nick, I don't know if you have anything else, but
No, I don't think so. This has been
okay.
Really interesting.
Yeah, I guess the last thing I would say is more of a comment, maybe a question Apollo might speak to, but I've always looked at it as, we always think about affecting companies by what we purchase of their products, but this is really a way you can vote your dollars in a very meaningful way to affect social change and environmental change. Beyond buying a Tesla, you can invest in, greener technologies and lower emission technologies.
Yeah, absolutely. And I think that investing in a way that aligns with your values, I think it's hugely important, and it kind of sends a message. But beyond that, there are three things that I really believe can go along with that to really impact some change. And the first one is, as you said, is consumer behavior. I think that the clear message that we send, not just in the way we purchase things, but maybe in the way that we don't purchase things. I'm kind of, in my view, I'm kind of done with just buying little plastic trinkets that I'm going to use for a little bit and toss them out. I don't want to do that anymore. And even consumer behavior, that it's different. Like, frankly, I have to say, when I was in Lansing, this is like 20, 30 years ago, I didn't feel this sense of urgency. And one little thing, like I used to brush my teeth, and wherever I was, in Europe or where I lived, I used to brush my teeth and leave the water running. And that was something that I never thought about it twice. But now, living here in California, I would never do that. I just wet the toothbrush and then I turn the water back on when I'm done. So there are things that we can do ourselves that would impact change. And our actions really, really matter. So, the type of car that we drive, if you really care about that, your behavior, not just in terms of what you buy, but how you act, I think it makes a difference. The second one is, government regulations, smart government regulations can make a big impact. And that's a second way in which we can move the needle. And thirdly, I think it's technology. As technology improves, we find better ways to produce things, perhaps without polluting as much, as materials get better, buildings get better. All of these things are going to impact change. So investing is certainly an important element because it aligns your values with your investments. And beyond that, these three things, the consumers and their actions, the government regulation, and the technology, they certainly can help move the needle. I just don't think it's going to be immediate. I just don't, in my personal view, I think that you have to be careful to manage your expectations, that just because you invest and don't invest into a company, that might not necessarily mean that things are going to change overnight. And also, this is a process. It's going to take its time, and in the meantime, we will need some oil. We will need some other things. As long as you know what the end goal is and you move towards that, I think it's important, because a lot of folks, and including us at Dimensional, we really think that it's really important for us to pay attention to climate change. It's real, and in that respect, talk about behavior, we have decided to become carbon neutral, and we've taken steps. And this year we were certified as carbon neutral, and we're paying attention to our emissions footprint. So I think that's going to go the way, not just kind of say, I want to invest this way, but actually, what are you going to do yourself to align not just the values, but your actions with the way you invest.
Well, I think that'll probably wrap it up. We really appreciate your time. These are some very useful insights, and thank you for being here.
It's been great fun, and boy, I hope to see you guys in person soon enough.
Yeah,
I know there's a big game coming up this weekend, so we're not going to take any sides.
I've heard that. We'll let that one go. I'm lay low for the next 7 football goes. All right.
Awesome. Well, thanks, Apollo. We appreciate it. We'll have to have you back sometime.
I'd love to come visit with you folks. So thank you so much for having us. Appreciate it. And thanks for everyone for taking the time. It was great fun talking to you.
Yeah. Thank you.
Thanks.
Bye-bye.